We come now to the revision phase, and what I'm intending to do as we consider the actual pilot paper from the ACCA itself, what I'm planning to do is full workings, and I need to move between my workings page where we do all our little calculations and of course the main answer. We'll be moving backwards and forwards, if that's all right with you. So I've decided to do full explanations for everything. Every point explained rather than rushing through the questions, trying to do as fast as I can. Of course I can do it very fast against the clock. I don't want to do that. I want to do it slowly, systematically. What if this came up instead of this? How would you handle it? What's the background thinking behind each question? That kind of speed. So you actually benefit from this in some way. The main challenge, of course, is that the topics are mixed. They're all mixed up. So one minute you may be asked, why would you do something that occurs after the balance sheet date? Financial position date, do you reflect it backwards or not? So you have to use common sense to see if you can put something together there. Another minute you may be asked something about a partnership with a guaranteed minimum for one of the partners. How do the others share the shortfall? That kind of thing. Next minute you might have something on control accounts, suspense accounts, bank reconciliation statements, incomplete records, markups, margins, limited company accounts, bonus issues, share, rights issues, all that kind of thing. So the fascination of a test like this is it doesn't say here are 4 partnership questions, here are 4 company accounts questions. Nothing like that. It's all mixed up. So every minute you're doing something else. So I would suggest the best way for us to do it together is to do very detailed working so we improve our understanding. In the exam, obviously, you can work through the various questions, and for questions that you aren't sure of, you just leave them blank. You just make a little note, scribble it down on your little sheet of paper that they give you, lots and lots of sheets of paper. Just make a note of the questions that you haven't attempted, and you go back and do those. Alternatively, if you want to guess, so at least you've done it, and then just make a note, put a little question mark besides the ones that you feel that you need to. So what I would do as I'm doing my questions, on another sheet of paper, I'll just do a little question mark and say questions 3, 5, 11, 16, not too sure. And so as I come across them, I just make a little note on this piece of paper. And then once I've done the entire 50 questions, I'll come back and reconsider those questions that I had problems with. So that's the way to do it. Be very organized. The biggest thing of all is if you're not sure about something, have a guess. Make a guess, actually decide before you finally submit it. It's a lovely exercise, it's a brilliantly thought out scheme on the part of the ACCA. The questions, I've tried many of them myself, are very well conceived, very clear. They're pre-tested before the student actually does it. There are a group of people who are selected to go up to the head office in Glasgow, and they're made to pre-test all these questions to make sure there aren't any blips and bad wordings and commas in the wrong place and so on. Also the time allocation to see whether a typical collection of 50 questions is fair. So what will happen is the pre-testers will be given something like 70 questions, because often they'll be experienced lecturers and authors and so on. And some people from practice as well, and they'll be made to test out to make sure. So never worry as a student when you come across questions whether the wording is wrong, whether they've been carefully pre-tested confidentially by valuable members of the teaching and accountancy fraternity. So don't worry about it. ACCA invests a lot of money in getting all that sorted out. So be confident that what you have in front of you is correct and is going to work, and there are no blips and ambiguities. Right, now let us make a start. The questions themselves can be found in the package. Here we are. It says there are 50 questions and all are compulsory. They must be attempted. Here are the various questions. So I need to jump backwards and forwards between my questions on the computer screen and my workings. So we come to the first question. Please use the candidate registration sheet. Okay, not too bothered about that. You'll have enough instructions to read. Should details of material adjusting or material non-adjusting events after the balance sheet date, by the way, balance sheet date equals obviously the statement of financial position date. Please don't forget that. When the questions were framed, ACCA used the word balance sheet, today of course known as statement of financial position. So with that one proviso, a superb test of every part of the syllabus. Very well conceived, I have to say. So, should details of material adjusting or material non-adjusting events after the balance sheet date be disclosed in the notes according to the IAS on the subject? And the answer quite simply is non-adjusting. So that's the answer, non-adjusting events. And that should be in the notes only. Adjusting, of course, means the figures in the final accounts need to be adjusted. Figures in the final accounts need to be adjusted. So the answer, of course, is B. Clearly, when you're facing a computer screen, if indeed that's your choice of style of question, you just click B and move on. And the screen will prompt you to move on to the next question, and so on. It's brilliantly laid out, very, very easy to follow. As you might have guessed, I had a few experiences of these tests myself. And I deliberately did that so I could speak to you with complete confidence that it is so easy to do. Even if you're not hot on data processing and computers and it isn't your field, it's still very, very easy to pick up within a few seconds. So what you might consider doing is get onto the ACCA website and see whether you can do a trial run of a few questions. They do have those exercises for you to experience, so please have a look. However, let's move on to our second question. This one looks like it's going to have some workings. So even though the first one is 1 mark and this is 2 marks, this is really something like 4 times as long as the first question. But there is a fairness in there somewhere. It all evens out in the end. So don't worry if you're taking slightly longer than you'd expect for this particular question. So this is quite searching. At the 30th of June 2005, a company's allowance for receivables was $39,000. At 30th of June 2006, trade receivables totaled $517. It was decided to write off debts totaling $37,000. So I'm going to underline there, write off debts. And to adjust the allowance for receivables to the equivalent of 5% of what the receivables now are. What figure would appear in the income statement for the year ended June 2006 for these items? It's a very hard one to judge without doing serious workings. And it is to those workings we now turn our attention. So if I may go back to where we are doing all our workings, or set this up for the first time. Here we are. Don't have to do workings for everything, but where it helps, you must clearly do them. So these are the workings. These workings are just for your own purposes. ACCA don't take them in. Question 2, something about allowances for receivables. As usual, I'm not going to rush through these. I'm going to take my time trying to explain how they work rather than just trying to beat the clock. Of course I can do that, but it won't mean very much to you. So is the trade receivables 517,000 less the amount written off, of course, is 37,000. So what's left, of course, is 480. So what's left is 480. That's the net remaining. That 480, you take your 5% thereof, and 5%, of course, of that is 24,000. And that's the allowance needed. So the first thing is to write off the bad debts, the irrecoverable bits, and whatever is left, 480, you take your 5% thereof. Obviously, this 24,000 was, at the start of the year, end of last year, 39,000. So what I'm thinking of doing is, if it was 39,000 once upon a time, and I need to write it back to 24, we're then going to say, if I can just do a quick little T account, if it helps. Don't do too many T accounts in the exam unless you feel it helps your cause. But certainly in class, as we listen to this tape, I'm going to try to do these little T accounts. So the allowance for receivables, or provisions for doubtful debts, as it's called. It's like a provision. Provision, of course, is a credit mainly. So the opening was 39,000. The closing, as calculated by you, is 24. And so if you take one away from the other, $39,000, and so you have your 15,000, which goes clearly to your income statement. So it's almost like you're debiting your allowance and you're crediting your income statement with 15 and 15. So where do we stand with all of this? Clearly, I needed to charge. Therefore, income statement, a summary. You will remember a few minutes ago, we charged 37 as a bad debt, irrecoverable debt, and we credited a few seconds ago 15,000. So I suppose what figure should appear in the income statement? One should be going for 22,000 as the answer. And surely that is there. Yes, it is. Greatly relieved to see it is actually there. That's one of the challenges, of course. You do a wonderful calculation, then you look at your A, B, C, and D and say, whoops, it's not there. So you try again and say, I must get close to these. But the wonderful thing, of course, is if you do it independently and then you look at it and you find it there, you can just tick it off. So do be careful. Take your time over your adjustments, your steps, the workings. As I was saying earlier, please allow me to do it very, very slowly and explain every step, what you might do, indeed what you might get, even if this particular question doesn't have it in it, on a what-if basis. I want to do it like that. So the answer there is B. So let's go back to our earlier exam question and make sure the marker can see a very clear B. Indeed, on the computer you click B and make sure nothing else is selected. All right, so there you are. A couple of marks for something that took a bit of time, but eventually it all evens out, so don't worry about that. Let's move on. In times of rising prices, in times of inflation, says the question, what effect does the use of historical cost, the basic accounting concept, have on a company's asset values and profit? You see? Now, quite interesting, historical cost simply means it isn't allowing for inflation. Not allowing for inflation. Let's say inflation is 5% in a particular country. If you base depreciation on the old costs, let's say you have not allowed for inflation, in other words, you have not upgraded your figures, indexed them up to allow for inflation, we just left them at the old figures. Clearly, depreciation is based on old costs, not the current market values. And if depreciation is undercharged, profit is overstated. You see? So because your depreciation is undercharged, because your asset values themselves have been understated, it does look very much like point C. So I'll go through that again. There are two ways of doing accounting. One is to use the historical cost accounts, which is historical cost convention, as it's called, just normal accounting, where you do not allow for any kind of inflation. You leave the assets at cost. And the other way, of course, is to allow for inflation. Now, the detail of how you allow for inflation is outside our syllabus, but the concept of it is something you need to be able to hold on to. In years gone by, we used to have two systems of accounting for inflation. One is where you allow for general inflation, the general, as they say sometimes, retail price index, general inflation. That's called current purchasing power inflation, CPP. And the other is called current cost accounting, CCA, which is specific inflation. Now, general inflation may be 5% based on a big basket of commodities that a particular government might choose to put into the basket so as to work out a general index of general inflation. Whereas specific inflation is much more the prices of my suppliers affecting my goods and services. In other words, if I bought some revision manuals from a particular supplier, let us say, and that supplier puts up their prices by, say, 20%, there's no point me arguing with them saying, well, general inflation is 5%. What do you mean putting it up by 20? I mean, I might. And they might say, okay, not 20%, make it 18. But the fact of the matter is, if they put their prices up by 18%, specific inflation affecting me through the supplier's prices going up is much more felt by me rather than just general inflation, which includes things that are irrelevant to me, foodstuffs and things like that. And so you see the difference. Specific inflation is where the supplier puts up his or her prices, and I'm affected by that. I'm buying manuals in. I'm buying petrol in to run a taxi company, for example. Specific inflation. General inflation is more to do with, just the general change in prices. So specific inflation is something called current cost accounting. The other one is called current purchasing power accounting. But the detail of that, indeed even the names, very much on the periphery of the syllabus. What you need to know is something like this. So I'll just run through that point C once more. It says there, in times of rising prices, what effect does the use of ordinary accounting, without allowing for inflation, have on a company's asset values and profit? Clearly point C is best because you have not revalued upwards to allow for inflation, even if it is just general inflation you're allowing for. So you have not revalued upwards, so the assets are understated. Also, the depreciation that you charge is smaller, and because of that, of course, your profit is overstated on the grounds that you have not charged enough depreciation. So point number C looks the best fit in the context of our little question challenge. So sometimes you read all four, you see, and some of them get pretty close, so you make a judgment, you say, now, which one is it? Point number C, of course, here looks to be the best fit, so I've decided on that. Another way of doing it, of course, is you look at your ABCD and say, I think point C looks good. And then if you're absolutely certain reading it that it is the one, just ignore the rest and move on. That's absolutely allowed, provided you're absolutely certain that that is the one that is correct. So you don't have to eliminate the others. And so we move on to point number 4, which is very much the kind of point I was trying to make just now. The International Accounting Standards Board framework for the preparation and presentation of financial statements gives qualitative characteristics that make financial information reliable. Now, this is quite a difficult one if you have not read anything about this. Which of the following are examples of those qualitative characteristics? Clearly, accounts have got quantitative characteristics, and those are the figures, obviously. But the qualitative is something else that's in the accounts, things that are assumed by the user of the accounts. Things like faithful representation, neutrality, and prudence. Now, all of them are pretty close. All of them are fairly close, but A is what the framework says. So what's this framework? It's like a conceptual framework of accounting that the International Standards Body published before the very first accounting standard was ever published. The first accounting standard was IAS 1, International Accounting Standard number 1, which had things like formats. Indeed, it had some of these concepts as well. Things like substance over form and lots and lots of concepts. It also had formats, what accounts look like, the income statement, the statement of financial position, etc. So it's quite a big standard, but that's IAS 1. The framework is more to do with concepts, though it says here which ones are the ones you must pick up. And A is the one that the IASB framework refers to, faithful representation. It's a bit like true and fair. You see, the accounts, don't forget, are a window to the company itself. In other words, if you walk past a big shop window, what you see displayed in the window must reflect truly what is in that shop. So there's no point the window showing me the most wonderful goods, and as a shopper I'm drawn into the shop, and as I get past the window thinking, all these wonderful goods are available here, I walk through the window and I see a very bland, old-fashioned, dusty, hopeless, unattractive shop behind the window. The accounts are what attracts me as an investor to go in past the accounts into the company where I want to make my investment. It's almost like the shop window for the company. And they have to be a faithful representation of what has actually happened this year. The truth and fairness overrides all else in many, many countries' companies' acts. So there you are, faithful representation. Neutrality. Neutrality, of course, accounts must be objective. As a sole trader, as a partnership, I mustn't squeeze through my accounts any personal expenditure. That is disallowed by the tax people. It should really be allowed in the accounts. So my aim is to make sure that the accounts are done on a neutral basis. It's almost like an umpire in a sporting occasion. If I see two people playing, say, a table tennis match as an umpire, I play a bit of that sport myself, if I get involved with my team, let's say I'm playing for them, but I'm just taking the role of an umpire for a little while. If I get involved with my team saying I must make sure that they win, I'm going to get biased, and that's terrible. Because if I'm wearing the hat of an umpire, I must be neutral. And that is why accountants are very highly regarded in many societies, because of their neutrality. Unfortunately, at times that leads to the fact that leads to people thinking of accountants as being so detached, neutral, objective, as to have no blood in their veins whatsoever. They tend to be very conservative, you know, white shirt, red tie, that kind of thing. They might be seen as very neutral, and they might overdo that. But I think I'd rather have that than to have something where it's all biased and subjective and falsified and not true and fair. That would be awful. So it's better to go to the other extreme, and that is what the accounting standard assumes we do. Faithful representation, that is to say true and fair. Neutrality, that is to say objective. And the last one is prudence. In other words, profits are not overstated, because clearly if you overstate profits, too much could be paid out by a company to its shareholders, and if something has been overestimated in terms of profit, for example, it's not going to be possible to ask shareholders for the money back by way of dividends, of course. If you pay them a dividend, you can't ask for the money back. So they tend to be quite cautious in working out how much profit to report. So that's where the word prudence comes from. A little bit of caution and conservatism, that kind of thing with a small c. All right, so there you are, faithful representation, neutrality, and prudence. All the others are pretty close, but that's the one, point A, that the IAS framework wishes you to use. So I'm going to go for ticking off point A. And so we march on to the next challenge, and the next challenge, and so on. So let's move on. Would you kindly read number 4, please? In fact, we moved on to 5 at this stage. The following bank reconciliation statement has been prepared by a trainee accountant. Oh dear. The word trainee is the broadest possible hint that the accountant, the person doing the work, is inexperienced. So near the word trainee, I'm going to put in the word inexperienced. And often the implication in an exam question is that there may be the odd mistake in there. I apologize if you are a trainee, but that is what examiners imply. Whenever they say trainee, the student is on guard that there's the odd mistake in here, bracket in the wrong place, that kind of thing. So take it in the right spirit, no insult intended. Overdraft per bank statement 3860. Outstanding checks 9160 and so on. So they've gone and deducted the 2 because of the word less, and they've added deposits credited after date. And so you come to 21,990. What should the correct balance be per the cash book? Now, that's one of those things where you can't just read A, B, C, D and make a judgment. You actually have to do the calculations. So wherever you wish to do it, obviously on your workings page would be ideal. So what you need to do is to keep your workings page nearby as well as the computer screen as we attempt these little questions. So point number 5, moving on. Because it's an inexperienced bookkeeper, accountant, I'm going to change things that I feel are wrong. So the bank reconciliation statement, no particular date given. The overdraft is said to be 3860. I think because it's an overdraft, one should be thinking of putting it in brackets. Overdrawn, negative, liability. Now, the outstanding checks, OS, speed is of the essence in the exam. The outstanding checks is 9160. That's what makes it worse. Makes the opening balance worse. 9160. And so the running total is 13,020. 13,020. Going to add that up. I suppose that ought to be in brackets as well. Then you have your uncredited items. $16,690. Perhaps that will save the situation a little bit. So I'll put that in without brackets. And tapping that into a calculator, we find ourselves with 3670. as the favorable cash balance, 3670 as a good balance, positive. Favorable balance, 3670, I should say. Is that, oh yes it is, that's point B. So let's go back and faithfully tick off. Point B appears to be the answer here. A favorable balance at the bank per the cash book. So it reconciles with the cash book. So that equals the cash book. And of course it's meant to reconcile with bank statement after adjustment. You will remember, of course, the way we do bank reconciliation statements. You start with the bank statement that the bank has objectively produced and sent to you every month, every week, whatever it might be. Let's say at the year end. You look at this balance, you then look at your cash book, and you tick off items that appear on both sides. And the items that do not or unticked in the cash book, you introduce them into the bank statement. And the bank statement items that are unticked in the cash book, you bring that into the cash book. So you correct the cash book, and then you attempt to reconcile the corrected balance, obviously, to the bank statement. So it's a very interesting exercise, one of the fundamental skills. You expect it to be examined to some extent in every sitting. So here we are, as we stand on the edge of question number 6. So not bad, 5 questions. I'm doing them very slowly, so I'm trying to explain everything I possibly can to prepare you for that big day. So number 6 then, coming up fast. Which of the following calculates a trader's net profit for a period? So net profit, I see. Now, different ways you can approach this. Clearly, as you read A, B, C, and D, you can go around in circles and never stop wondering how this is going to work. Probably the best thing to do, what I do personally, is to have a framework that never changes, the kind of thing we did under our incomplete records. In other words, we'll start with our opening net assets, you see. We'll add to that capital introduced, add to that net profit for the year, and so you do a running total. You then deduct from that any drawings. So you start with the opening capital, you add any fresh capital introduced, you add any net profit, come to a subtotal. From that you deduct the drawings for the year, and so you come to your closing net assets. I personally would always do it like that, move from opening to closing. If one of those items is missing, let's say drawings, you just need to work backwards, being sensible, and you come to the answer. I personally am not in favor of changing the order of the structure to suit each question. Have a structure that's absolutely rigid in your mind. It's almost like saying, statement of financial position, this is how I do it. And if something is missing, I can work out where it's slotted in. So my personal choice would be to make it a fixed format in your mind, a tiny little calculation, and never depart from that. It's like when we do incomplete records, if someone says to you, what is cost of sales? What is cost of sales? It's opening stock, opening inventory, plus purchases, less closing. Now, if you start changing them around to suit each question, the thing tends to collapse a little bit. It's very similar here. I see those two on more or less a par in terms of difficulty, or shall we say easiness. So let me show you exactly what I mean as we attempt point number 6. This is perfect revision for what we have done on the long part of the course. So here we are. Let me go back and pick up some more of these marks. So just for our own benefit under exam conditions, staring at a computer, we must be really clear which one we are doing. We're doing question number 6. No need to have for big headings. The framework that must be mastered. Framework. It comes in incomplete records. Comes into incomplete records. The framework, of course, is the opening net assets. plus capital introduced. So opening net assets plus capital introduced plus net profit for the year. NP is net profit. And so the running total there is that much. Away from that, of course, is drawings. He's taken drawings, and so that final figure there is our closing net assets. So someone said to you, how do you work out the profit for the year? Quite simple, really. You do the opposite as you work backwards. So you're working in this direction, you just do the opposite. So rather than saying instead of saying minus drawings, you say add drawings. So closing net assets, starting with the last one, plus drawings, working backwards, minus capital introduced, minus opening net assets, equals net profit for the year. And that is comfortably item number A. Okay, so I'll run through that again. Closing net assets plus drawings, because if you're working backwards, upwards, you need to do the opposite sign, you see. There are no figures. Figures would have been a bit easier. But without figures, it's more of a challenge. We can still manage it, though. Open the closing net assets, add back drawings, opposite function to this, minus capital introduced, opposite function to that, minus the opening, opposite to this. This is like a plus, but the opposite to that. And so that's a minus. And so comfortably we're looking at point number A. It is therefore to that we now turn our attention. Point number A most definitely is the answer. All of the others look pretty close, but if you're certain that A is the answer, you don't have to check. You don't have to check points B, C, and D. Right, let's march on to point number 7 as we do business with this massive, massive exercise. A sole trader took some goods costing, might underline that, 800 for his own use. I see, the normal selling price of the goods is 1,600. Interesting point that. All three of them look quite attractive, but the one I must go for is B. In fact, a standard journal entry, if something is taken from goods for own use, it's like a drawing. So your debit drawings, you're going to debit drawings, it is on the debit side, and you're going to credit purchases. No problem. So the answer is B. Now, clearly, if you start crediting purchases, it reduces business purchases and avoids distorting the business gross profits. Can I just, on the face of my question paper, just in class, as we do this together, the concept is it reduces business purchases and avoids distorting the business gross profit. Okay, so that's why you're crediting purchases, and of course debit drawings for a sole trader partnership. Of course, the partner sole trader must suffer. So the debit goes to drawings, and ultimately that ends up, if you're doing a partnership, to the current account. Here, of course, we're doing a sole trader. Ends up in the same position. It would be in the drawing section of that little format we saw in question number 6 a few seconds ago. Now, one of the nastiest bits of the syllabus, unfortunately, is this suspense account and that sort of area. So what you and I need to do is to face some of these questions together as we try out question number 8, say. The debit side of a company's trial balance totals 800 more than the credit side. So the debit side, debit is more than the credit side. So the trial balance doesn't balance. Which of the following would fully account for the difference? The word is fully. And which one of the following? That's interesting. So it's not like several need to be ticked, just the one. That makes life a lot easier, of course. So let's go for the first one. 400 paid for plant maintenance has been correctly entered in the cash book. So if you've paid it, I presume the cash book has been credited and also been credited to the plant asset account. So you've credited cash and you've credited plant. Now this I'll be writing on my working sheet, not obviously writing on the, can't write on the computer screen in the exam. So I'm crediting cash and crediting plant. So the cash seems to be okay, you see. That to me seems okay. The credit to the plant is what is wrong. And the credit is too much by 800, you see. So instead of crediting plant, indeed, instead of going for plant maintenance, I've gone and credited plant account with 400. It's got nothing to do with plant account. It should have gone as a debit to the plant maintenance. So instead of having a debit of 400, I have a credit of 400. So actually the credit has been doubly stated, too much by 800. Quickly check to see what the first sentence says. The debit side of a company's trial balance totals more. So that is exactly wrong. You see? So it looks tempting, but it's actually wrong if you're patient and read it. So the credit is too much by 800. I'm talking about the first one. So that is not right. Point A is wrong. It's close, but wrong. The next one, discount received 400 has been debited to discount allowed account. So discount allowed has been debited with 400 instead of obviously the discount received. So I'm going to say that the discount allowed has been debited instead of discount received being credited. So I would say the debit is overstated by 800. Debit is overstated by 800. There should have been a credit. Debit side of trial balance should have had, the trial balance should have had a credit, but it's got a debit. So the debit is 400 plus 400, 800. Too much. Is that? Oh yes, there it is, you see. That indeed is your point B. Now, if you're certain, absolutely certain that that is the answer, you don't have to bother with C and D, because all that will happen is you'll waste time and you just go around in circles and might doubt your earlier choice. But you have to be certain that B is right before you can abandon C and D. But in class, just because we have this time together, I just want to have a little look at C and D. C, a receipt of 800 for commission receivable has been omitted from the records. So it seems like both sides of the entry are omitted and the trial balance will balance. You follow that? A receipt for commission receivable has been omitted from the records. So the whole account has been omitted. So because the debit and credit has been omitted, the trial balance will still balance. So omitted from the records implies that both sides have gone. So that's not acceptable. It won't be our answer anyway. And then the last one, the petty cash balance of 800 has been omitted from the trial balance. So the debit balance is understated by 800. If you go back to the original sentence, it says the debit balance is higher by 800. Here, it's lower by 800. So that's exactly wrong. So point C and D are both wrong. A looks wrong. So I'm coming around to saying that B is correct. But as I say, you look at them and begin to eliminate them. If you come across something that you know is right, because only one can be right, And if you're certain that it's right, just choose it and abandon the rest. Don't bother to check C and D. Thereby you save a few precious seconds. From my experience of doing these tests, that is something I'd recommend to you. And so we'll march on, with your permission, to fight our way through question 9. A company's income statement for the year to 31st of December 2005 showed a net profit of 83,600. I see. It was later found that 18,000 paid for the purchase of a motor van had been debited to the motor expenses account. So we need to add back, I suppose, 18,000 to profit to correct it, to net profit to correct it. It is the company's policy to depreciate motor vans at 25% per year on the straight line basis with a full year's charge in the year of acquisition. It's one of those absolutely certain items, or at least it has a very high chance of coming up, let me put it that way. There will be something on depreciation in the exam. So when you're ready, question number 9. How do we work this out? Net profit 83,000. So net profit old 83,600 could be a good starting point. It was later found that 18,000 paid for the purchase of the motor van had been debited to the motor expenses account. So I suppose I must add back expenses wrongly charged. It's got nothing to do with motor expenses. 18,000. So I'm going to add that back. And of course, inevitably, if the motor van had been purchased, there's a bit of depreciation attaching to that. Now, I find this very easy. I'm sure you do as well. Charge depreciation for the year, for this year. And that appears to be 25% of 18, which feels like 4.5. So I take that away. I suppose my 83,600 upstairs is added to by 18, deducted. You deduct 4.5. So it'll go up by 13.5 to about 97.1. And that's the correct net profit, apparently. Yes, there it is, point number C. It's always a relief to find it in the choice of A through to D. So let's go back and start ticking off some of these items. Item number 9, of course, point C. Notice the computer doesn't care about your working, so you can do as little as you like. Drop the zeros and just do decimals if you prefer. Anything that's fast, but it mustn't in any way disadvantage you in terms of accuracy. Use abbreviations wherever you can. No one's going to see your working papers, but don't confuse yourself by having too brief. Especially if at the end of the end of the exam you have a few minutes to spend, you want to come back and check. Wherever you've done a working, be very clear. This is question 9, this is question 10. Be very clear, leave gaps and so on between, because you get lots of paper to use in the exam if you wish. Right, so there you are. Number 9 took a long time. Of course it did, because it's quite detailed. We're now moving to number 10, which really take a split second. Should dividends appear on the face of a company's income statement, yes or no? You're right, the answer is no. It goes into the saucy, doesn't it? Goes into the statement of changes in equity. Of course, it doesn't go into the reason why it goes to the statement of changes in equity is obviously because if a company has had a bad year, as currently in many parts of the world, companies are going through some difficult times, if they do not have enough money out of this year's trading to finance the dividend, but in years previous they had plenty of profits but not much dividend, that brought forward profit from earlier years would finance this year's dividend, within certain safeguards, obviously, in company law, which you will cover in F4. But let's say there are no problems like that. So in the past, they've made profits. This year, they've made a very small profit, maybe even a loss. You are allowed to bring forward previous year's profits, and out of that, the dividend is paid. If the dividend is shown in this year's income statement, then the company has to make a profit this year to actually pay out a dividend. So they tend to make the dividend something that is shown separately, highlighted for the shareholder, statement of changes in equity, and it's sometimes financed by the brought forward profits from previous years. So that's why they do it away from the income statement, for the reason of previous year financing it, and the other reason, of course, it highlights it for the shareholder who's very interested in the dividend, of course. So lots of reasons why they changed the rules there. So that didn't take long at all if you discount my explanation, which was just there for tutorial reasons. We now come to something that will take much, much longer to do, and this is a little test of the control account exercise. The following control account has been prepared by a trainee accountant. So once more, without wishing to insult you in any way, there may be some mistakes in here. Well, that's the implication. So let's look at it, confident in the knowledge that we'll find the odd mistake. What should the closing balance be when all the errors made have been corrected? So what should it be? For that, you need to know the basics of control accounts, to know what should have been done before you can point out an error that someone else has made. So for that, if you have problems, go back and revise the control accounts chapter, the session we had, with all those examples. So the opening balance is nothing I can do anything about. So looking through our various bits and pieces, it looks like the cash sales is definitely not right to be shown here. Should not feature. Should not be here. The contras against credit balances in the payables ledger. Now, I think that should be on the opposite side, don't you? Because sales ledger control account, or shall we say receivables ledger control account, like a customer, see, is our asset, because we're going to receive this money from these folk. So if there's a contra, the debit balance, which currently stands at 308,000, must be cancelled, or some of it, the opening balance, or even some of the sales, must be cancelled by putting the 46 on the opposite side to the opening balance and the credit sales. So cash sales initially should not feature at all, and the contras on the wrong side. So should be on the opposite side. So that needs to go to the other side. What else? Cash received from credit customers looks good. Discounts allowed looks good. Interest charge on overdue accounts. I don't suppose it should be on that side. It should come around to this side, shouldn't it? That should be back on this side. Perhaps I can do the arrow above the line, so to speak, included in this here, because obviously if they haven't paid for a long time and you wish to charge them interest, the amount that they owe you goes up. So the interest on outstanding accounts means more is receivable. So you put that onto the debit side. So that's on the wrong side as well. What else? Bad debts looks okay. Allowance for receivables, close but should not feature. Should not be there. Allowance for receivables. So it's not actually on the wrong side. It just shouldn't be there. It's a bit like cash sales. That should not be there. It's not that's on the wrong side. So you have two kinds of problems here. One where something is on the wrong side, so you just put it on the right side. And the other, of course, is where you have your items. So there you are. That's the kind of thing we are having to look at. So can I ask you please to consider doing that yourself? Stop the tape now, open up a nice big T account and run through that, see what kind of answer you can come up with first, please.